Donald Trump's recent executive order marks a transformative moment in the U.S. financial landscape by allowing cryptocurrencies and other alternative assets to be included in 401k retirement plans. This decision opens the $9 trillion U.S. retirement market to digital currencies, private equity, and similar investments, breaking away from the traditional focus on equities and bonds. The order requires U.S. regulators to update existing frameworks that have previously restricted access to these high-growth assets within professionally managed retirement accounts. This move is seen as a significant endorsement of digital assets, potentially setting a precedent for other major economies to follow suit. The implications of this policy shift are profound, as it could channel hundreds of billions of dollars into the cryptocurrency market, fostering infrastructure development, innovation, and broader acceptance. While the inclusion of digital assets in retirement plans offers new opportunities for diversification, it also introduces unique risks due to the volatile nature of crypto markets. Nonetheless, with professional oversight, the long-term benefits could be substantial. This regulatory change not only reshapes investment strategies in the U.S., but also prompts global pension funds and asset managers to reconsider their frameworks, signaling a deeper integration of cryptocurrencies into the global financial system.
President Donald Trump has announced a significant policy shift by imposing a 100% tariff on all imported semiconductors, a move aimed at reducing U.S. reliance on Asian chip manufacturers. This tariff is notably higher than the previously suggested 25% and is part of a broader strategy to promote domestic manufacturing. The policy exempts companies that produce chips within the U.S., thereby incentivizing local production. This decision could have substantial implications for major semiconductor companies like AMD, Nvidia, Intel, and Qualcomm, which currently rely heavily on Taiwan's TSMC for chip manufacturing. TSMC, which is in the process of building new plants in Arizona, has expressed concerns that such tariffs might deter future investments in the U.S. In response to the tariff announcement, Apple has increased its U.S. investment target from $500 billion to $600 billion, with plans to expand partnerships with American suppliers. This includes a new Corning facility in Kentucky, which will produce glass for Apple's devices. Despite these investments, Apple will continue assembling iPhones overseas for now. Though CEO Tim Cook hinted at potential future reshoring efforts, the tariff's immediate effect could disrupt the global technology supply chain and exert additional pressure on the electronics sector, potentially influencing market dynamics and investment strategies across the industry.
DraftKings Inc. reported robust financial performance for the second quarter of fiscal year 2025, setting records for both revenue and adjusted EBITDA. The company achieved a 37% year-over-year increase in revenue, reaching $1.513 billion, while adjusted EBITDA more than doubled to $301 million, marking a 20% margin. This growth was driven by enhancements in product offerings and efficient cost management, positioning DraftKings to potentially meet the high end of its fiscal year guidance. The sportsbook segment, a key growth area, saw a 45% increase in net revenue and a notable improvement in net revenue margins, which rose by over 230 basis points to a record 8.7%. The company's strategic focus on innovation and customer engagement, particularly in live betting, has contributed to a 16% year-over-year increase in live betting handle. DraftKings' ability to capitalize on favorable sportsbook outcomes added $110 million to its revenue in May and June. The company is also exploring opportunities in federally regulated prediction markets, aiming to enhance shareholder value. Additionally, DraftKings repurchased 6.5 million shares in the first half of the year, indicating a commitment to maximizing shareholder returns through strategic capital allocation. As the NFL and NBA seasons approach, DraftKings is poised to leverage its leading position in the sportsbook market to drive further growth.
In July, SoFi Technologies, Nasdaq SoFi, experienced a 26% surge in its stock price, driven by a combination of impressive second-quarter earnings and strategic product launches. The digital bank reported a 44% year-over-year increase in adjusted net revenue, marking the highest growth in 2 years, alongside a notable rise in earnings per share from 1 cent to 8 cents. SoFi's expansion strategy, which includes cross-selling new products to its rapidly growing member base, resulted in 850,000 new members and 1.26 million new products added during the quarter. Additionally, the return of cryptocurrency trading and the introduction of investment opportunities in private funds further fueled investor enthusiasm. The company's lending segment benefited from lower interest rates, with a 30% increase in lending revenue and record personal loan originations. Meanwhile, its non-lending financial services segment grew by 106%, significantly contributing to its bottom line. Despite these positive developments, SoFi's stock faced a 5% decline in early August due to a new equity offering priced below the current market value, causing some investors to moderate their expectations. Nevertheless, SoFi's robust growth trajectory and strategic initiatives continue to position it as an attractive option for growth-oriented investors, albeit with inherent risks typical of high-growth stocks.
Toyota Motor Corporation has projected a substantial financial impact from U.S. tariffs on imported cars and parts, estimating a potential hit of approximately $9.5 billion. This marks the largest such estimate by any company, reflecting the intensifying pressure on global automakers due to rising costs from U.S. levies on cars, parts, steel, and aluminum. Consequently, Toyota has revised its full-year operating profit forecast downward by 16%, now anticipating an operating profit of 3.2 trillion yen, $21.7 billion, for the financial year ending March 2026 compared to the previous estimate of 3.8 trillion yen. The tariffs, introduced by President Donald Trump, have notably affected Toyota's North American operations, which reported an operating loss of 63.6 billion yen in the first quarter, contrasting with a profit of 100.7 billion yen in the same period last year. The broader automotive industry, including companies like General Motors, Ford, and Stellantis, is similarly grappling with these tariffs, which have led to significant profit declines and revised financial forecasts. The tariffs, ranging from 15% to 41% on various imported goods, are part of a broader U.S. strategy to generate revenue and address trade deficits, projected to bring in $50 billion monthly. However, they have increased costs for U.S.-based companies importing goods, potentially leading to higher consumer prices and inflationary pressures, as seen with companies like Hasbro and Procter & Gamble. In the global context, these tariffs have strained international trade relations, prompting some countries to seek new agreements or reprieves. A new trade agreement between the U.S. and Japan promises to reduce tariffs on Japanese auto exports, but its timeline remains unclear. Despite these challenges, Toyota reported record global output and sales in the first half of the year, driven by strong demand in North America, Japan, and China. The evolving trade environment underscores the complex interplay between U.S. trade policies and global economic dynamics, with significant implications for corporate strategies and international trade relations.
Morgan Stanley has revised its price target for AMD Advanced Micro Devices, following the company's impressive second quarter earnings report. Despite AMD's strong financial performance, driven by its robust AI, artificial intelligence narrative, Morgan Stanley remains cautious in its outlook. This caution reflects broader concerns that could influence sentiment across the semiconductor sector. AMD's earnings report showcased significant growth, particularly in sectors related to AI, underscoring the company's strategic focus on this burgeoning market. The cautious stance taken by Morgan Stanley highlights a divergence in Wall Street's reception of AMD's performance, emphasizing potential risks that could impact future growth projections. The semiconductor industry, which is highly sensitive to technological advancements and market demand shifts, might experience volatility as investors weigh the implications of AMD's strategic direction and the broader economic landscape. This development is crucial for stakeholders as it may affect investment strategies and market valuations within the tech sector.
Wall Street experienced gains as the Nasdaq 100 rose by 1.2%, driven by optimism surrounding potential Federal Reserve Fed policy easing and robust corporate earnings. Apple shares surged by 5.1% following the announcement of a $100 billion domestic manufacturing investment aimed at mitigating tariff impacts. The broader S&P 500 saw approximately 80% of its companies surpass second quarter earnings forecasts, with notable performances from Arista Networks, which saw a 17.5% increase due to strong guidance, and McDonald's, which rose 3% on higher-than-expected sales. However, some tech stocks like Advanced Micro Devices (AMD) and Supermicro faced declines due to weak data center performance. The likelihood of a Fed rate cut in September has increased to 95%, as indicated by Fed fund futures, following weak payroll and services data. In contrast, the FTSE 100 opened 0.3% lower, influenced by the strengthening pound, which traded just below $1.34. The appreciation of sterling negatively impacted UK companies with significant US dollar earnings, such as AstraZeneca and Shell. Intercontinental Hotels, IC, saw a 9.2% rise in its shares after reporting revenue growth, while WPP continued to struggle, marking a 54% decline year-to-date, despite meeting expectations. The Bank of England (BoE) is expected to announce a rate cut, supported by positive housing data, which showed a 0.4% increase in house prices in July. This move is anticipated to further bolster the housing market, which has already benefited from lower mortgage rates and wage growth. The financial landscape remains dynamic, with ongoing tariff developments and corporate strategies, such as manufacturing investments, shaping market sentiment.
The global natural gas market is expected to experience substantial growth, with projections indicating an increase from $4.19 trillion United States dollars in 2024 to approximately $6.96 trillion United States dollars by 2034. This growth, driven by a compound annual growth rate of 5.20% from 2025 to 2034, is fueled by rising demand for liquefied natural gas, LNG exports, its application in electricity generation, and broader usage in power and industrial sectors. The transition from coal to natural gas, supported by environmental policies and commitments to reduce carbon emissions, further propels this expansion. Key market players such as ExxonMobil, Chevron, Royal Dutch Shell, and BP are positioned to benefit from the increased demand. Advancements in LNG technology and infrastructure are facilitating greater trade opportunities, with North America remaining a leading producer and the Asia-Pacific region emerging as the fastest-growing consumer market. This trend is driven by efforts to replace coal with cleaner energy sources and is underscored by significant investments in LNG networks by countries like India. Additionally, geopolitical shifts are prompting European nations, including Germany and Poland, to diversify their energy sources away from Russian pipelines. Natural gas is recognized for being a relatively clean-burning fossil fuel, producing fewer emissions than coal and petroleum. However, methane emissions from its production and distribution remain a concern, contributing significantly to greenhouse gas emissions. The U.S. Energy Information Administration reported that natural gas accounted for about 35% of the country's energy-related CO2 emissions in 2022, highlighting the industry's need to address methane leaks. As global energy strategies increasingly incorporate LNG, its role in international energy trade is poised to grow, supported by investments in production and export facilities by major producers like the U.S., Qatar, and Australia. The power generation sector continues to dominate natural gas consumption, with increased gas-fired electricity generation contributing to market expansion. Overall, natural gas is set to play a pivotal role in balancing renewable energy sources and ensuring energy security while significantly impacting global energy strategies and environmental policies.
The financial landscape for technology stocks remains robust, with Broadcom, ServiceNow, and Oracle showcasing remarkable growth and strategic positioning in the AI and enterprise software domains. Broadcom, Nasdaq, AVGO, has solidified its status as a leader in AI infrastructure, reporting a 20% year-over-year revenue increase to $15 billion in Q2 2025. The company's AI semiconductor business, particularly in custom accelerators and AI networking, is driving significant growth, with a 46% rise in revenue to $4.4 billion. Broadcom's strategic acquisition of VMware is enhancing its infrastructure software segment, contributing to impressive margins and strong shareholder returns through dividends and stock buybacks. ServiceNow (NYSE) Now continues to dominate the enterprise workflow automation market with its Now platform, generating $3.2 billion in Q2 2025 revenue. a 22.5% increase from the previous year. The company's focus on integrating AI capabilities through Now Assist is expected to quadruple its annual contracted business by 2026. With a high customer retention rate of 98% and robust free cash flow, ServiceNow is well positioned for sustained growth, backed by substantial cash reserves and strategic share repurchases. Oracle, NYSE, ORCL, is capitalizing on the demand for cloud infrastructure and database solutions, reporting an 11% increase in revenue to $15.9 billion for Q4 fiscal 2025. Oracle Cloud Infrastructure's 52% revenue surge underscores its critical role in supporting AI workloads across major cloud platforms. With a substantial backlog and expectations of significant revenue growth in fiscal 2026, Oracle is poised for continued expansion. The company's commitment to shareholder returns through dividends and buybacks further strengthens its investment appeal. These technology giants exemplify the sector's capacity for wealth generation, driven by strategic innovations and market leadership in AI and cloud services.
U.S. President Donald Trump has announced an additional 25% tariff on imports from India, effectively doubling the existing tariff to 50%. This measure, formalized through an executive order, is a response to India's continued purchase of oil from Russia, which the U.S. administration views as a circumvention of sanctions against Russia due to its conflict in Ukraine. The initial tariffs are set to take effect on August 7th, with the new tariffs being implemented after a 21-day notice period. The Indian Ministry of External Affairs has criticized the tariffs as unfair, unjustified, and unreasonable, emphasizing that India's energy imports are driven by market needs and energy security considerations for its large population. India has signaled its intent to protect its national interests, noting that similar transactions are conducted by other countries, including the US and EU. Economists have expressed confusion over the tariff decision, arguing that it is based on faulty assumptions and lacks economic rationale. Critics suggest that the tariffs align more with Trump's personal and political agendas rather than addressing genuine trade imbalances, as evidenced by similar threats made to other countries over unrelated political issues. This development is likely to strain U.S.-India relations, potentially impacting efforts to double bilateral trade to $500 billion by 2030, despite the U.S. being India's fifth largest trading partner with a trade value of $131.84 billion in 2024-25.